Gold is holding above $5,000. Silver is trading around $80. Oil has moved back above $100 per barrel. And the latest US inflation data shows price pressures are still refusing to return to the Federal Reserve's target. Normally, those things don't all rise at the same time. Yet this past week, they did. And when that happens, investors tend to pay attention. Because when gold, energy, and inflation data all point in the same direction, it can tell us something important about where the economy may be heading next. Welcome to Money and Power. And welcome to our weekly Saturday market update, where we step back from the daily headlines and look at what the markets may actually be telling us. Today, we'll look at what happened across gold, silver, oil, and inflation this week. And more importantly, what those signals could mean for the week ahead. Because one price alone very rarely tells the whole story. The real clues appear when different markets start moving together. And this week, that's exactly what happened. So where do the markets actually stand? Well, let's start with the numbers as we head into the weekend. Gold finished the week around $5,022. Silver closed near $80.66. Bitcoin is currently trading around $70,600. And Brent crude oil is holding close to $103 per barrel, with the US dollar index sitting at 100.36. Equity markets slipped slightly on Friday. The S&P 500 fell roughly 0.6%, the Dow Jones about 0.3%, and the Nasdaq close to 0.9%. None of those moves look dramatic on their own, but markets often send signals through how assets move together, not just through one headline price. And this week, the relationship between gold, oil, and inflation has become particularly interesting. Gold above $5,000, more than a milestone. Gold trading above $5,000 is more than just a headline number. Big round levels like this often act as a test. The market briefly reaches the level, pulls back, then investors watch to see what happens next. Does the price fall away, or does it hold steady? Right now, gold is doing the second, having fallen back from its high of $5,634 within the past month. Now, despite some volatility during the week, the metal continues to hold close to the $5,000, $5,100 level. When that happens, it often suggests larger investors are stepping in. These aren't traders looking for quick profits. They tend to be central banks, sovereign wealth funds, and institutional investors looking at longer-term risks. And those investors usually respond to bigger forces such as currency stability, inflation risk, and geopolitical uncertainty. If you watched our recent video explaining why gold has increasingly become the world's preferred safe asset again, you'll remember we discussed this shift in behavior. And you'll see that video appearing on the screen at the end of this report. Please click on it or the other two videos we recommend, because the price of gold often moves before the wider economy fully reacts. Silver, the industrial signal. Now, silver is telling a slightly different story. At around $80.66, silver is trading far above where it spent most of the last decade. Yet the market has not collapsed after the surge either. Instead, silver has recently been moving sideways in a relatively tight range. That may not sound exciting, but in markets, sideways movement after a sharp rise and then a moderate correction often means something important. It can mean the market is accepting the higher price level. Silver is unusual because it sits between two worlds. Like gold, it acts as a monetary metal, but it also plays a major role in industrial demand, particularly in electronics, solar technology, energy infrastructure, and advanced manufacturing. So when silver holds high levels without falling back too sharply, it can suggest that real demand may be supporting the price. And if silver holds here while the economy slows, it tells us the monetary side of silver is finally taking the lead. Now, oil above $100. Why energy matters. The third signal this week comes from the energy market. Brent crude oil holding above $103 per barrel pushes energy back into a zone that historically feeds into inflation. Energy sits at the center of the global economy. Transport relies on it. Manufacturing depends on it. Food production depends on it. When oil rises significantly, those higher costs eventually spread through the entire economy. Shipping becomes more expensive. Factories face higher operating costs. Businesses pass those costs on to consumers, you and me, and that's how inflation pressure often builds. So when energy moves higher, while inflation is already above target, investors start paying close attention and naturally become concerned. The inflation data. Those pressures were reinforced by the economic data released yesterday, Friday. The United States published its latest Personal Consumption Expenditures Index, usually called PCE inflation. This is the inflation measure the Federal Reserve watches most closely when deciding interest rate policy. The latest data showed core PCE running at roughly 3.1% year on year. That's the Fed's 2% target. The key point isn't that inflation suddenly jumped higher again. It's that inflation is proving harder to bring down than expected. After 2 years of aggressive rate increases, inflation remains above target. That puts policymakers in a difficult position. Raise rates further and risk slowing the economy. Lower them too quickly and risk inflation rising again. Markets are starting to recognize that challenge. The dollar signal. Another piece of the puzzle is the US dollar. The dollar index around 100.36 suggests the dollar remains relatively stable and strong. Normally a stronger dollar tends to push commodity prices lower. But this week, gold and oil both remained relatively elevated despite that, though gold did fall $150 and silver $4, with oil prices strengthening. That tells us something important. It suggests demand may be coming from longer-term investors, not just short-term trading. In other words, some investors may already be positioning for a world where inflation and geopolitical risk remain persistent. So why does this matter? Why should this matter beyond financial markets? Because when energy prices stay high, while inflation remains above target, the effects eventually reach the wider economy. Transport increases, manufacturing costs rise, business raise prices, consumers feel the pressure, and that can influence everything from mortgage rates to pension performance to investment returns. Markets often recognize these shifts before they become obvious in everyday economic data. That's why investors watch these signals closely. So as we move into the next trading week, 3 things will be worth watching closely. And these 3 things will be provided to our inner circled paying members of the 2% brief on Substack on Sunday evening at 7 p.m. GMT. So if you find this type of analysis useful, you may want to join the 2% brief on Substack. There is a free version where members receive the weekly updates and commentary like the one we're discussing today, and access to some daily notes that I put out. But the paid version goes much deeper. Paid members receive the full strategic breakdown of the forces shaping markets, including liquidity signals, central bank positioning, and the frameworks we use to interpret these developments so that current investors and potential investors can obtain a guide, not advice, but a guide as to what to look out for next. Tomorrow evening, ahead of the Asian market open, paid members will receive the full weekend briefing covering the scenarios we are watching for the week ahead. If that interests you, the link is in the description and comments below. Thank you for watching. If you like to explore the deeper forces behind the precious metals market, I recommend the videos appearing on screen now. And if you find this analysis helpful, please remember to like the video, subscribe to the channel, and enable notifications. And if you're willing to take that step, pop on over to the 2% brief. Look forward to speaking with you soon.